think about equities for a minute, talk about what's been happening this year. Again, it's August 8th, so the timestamp for people. But what are you guys paying attention to in the equities world? What's that telling you broadly in terms of that relation to what's happening to the macro? And any thoughts on moving forward, what we should be looking at?
So when we think about equities or any other asset class, we really think about them from the perspective of just three variables: real growth, inflation, and monetary policy. And those three variables tend to move up and down like a sine curve. Those three variables are the three subcycles of what we call the larger business cycle. And the reason that we focus on them is that they drive the vast majority of the price action for most macro asset classes. So that's stocks, but also bonds, commodities, and currencies. And bonds tend to be more sensitive to policy. Stocks tend to be more sensitive to growth. But those are the three variables that pretty much move everything. And not only do they drive the performance of the major asset classes, but they also drive performance dispersion within the asset classes. So sector performance, the performance of style factors like growth, value, large cap, small cap, high beta, low beta. So that's always all the economic analysis that we do is put into the context of that growth, real growth, inflation, and monetary policy framework. If it doesn't affect one of those things, then it's probably just noise. So Where do we go from here? Well, let's think about why stocks have gone up in 2023. So the short answer is mostly policy. So what policies have been a tailwind for stocks in 2023? The first was, ironically, the debt ceiling, right? It was a Treasury General account drawing down that injects reserves into the financial system. It puts downward pressure on interest rates, which tends to be a valuation tailwind for stocks, right? So everyone was talking about the risk of the debt ceiling. And what I think very few people appreciated was that it was, in fact, a boon to stocks. It wasn't a risk. It was an opportunity.
Right.
The second policy driver of equity performance this year was the banking crisis, another risk turned opportunity. And the reason is that the Fed had to turn on the money printers to deal with it, right? It expanded its balance sheet to provide these emergency lending facilities to regional banks that injected more reserves into the financial systems. Again, it's a downward pressure on rates. And it was stimulative for stocks. And since May, we've actually seen continued performance from the stock market as though the Fed were continuing to stimulate, even as policy tightened. That price action, it sounds like a cop-out, but we don't see a fundamental driver for it, right? And a lot of it has been concentrated in stocks with exposure to artificial intelligence as a theme. And so, this could be the beginning of an artificial intelligence bubble. We've obviously seen a few risk-off days, which, in the very short term undermines the bubble thesis. But when you see stocks or any asset performing a certain way, and there's no explainable fundamental driver for that performance, that's characteristic price action of a bubble. So it's something that we're paying attention to. And it's one reason that we really don't want to, we've been opportunistically long certain parts of technology, but it's a reason that you really don't want to short technology until the trend starts to break.